So you're looking to buy a property in an auction. How do you finance that? Can you use a standard buy-to-let mortgage? Well, that's a brilliant question, and it will be answered in this video by Simon Hodgson.
Okay, so I have Simon from Funded today talking about finance and how to finance your property deals. Simon, why don't you talk to us about someone that is buying properties in an auction and maybe using a bridge finance because they've got to do things quickly, which they can move on to a buy-to-let after they've done the refurb or conversion. What's your thoughts on that? Because I know that some people are a bit confused of what finance they need to put in place.
Yeah, absolutely. So, of course, shopping at an auction, you've got to complete in a certain amount of time. Traditionally, it's 28 days. If you're buying in what's known as a modern auction, they will sometimes extend that to 56 days. But in general, you're going to need to use a bridging lender. And the reason for needing to use the bridging lender is that a buy-to-let lender doesn't work to set time scales and completion deadlines. They will just continue to underwrite the case until they're happy to pass it on, and then it goes to a solicitor, and the solicitor then kind of takes their time. So you can't complete in time. Whereas a bridging lender, and not all bridging lenders do, will work to a set time scale. But traditionally, most people are put off by one, by the complexity, and two, by the cost. So the idea is to work with someone who works with bridging lenders quite regularly, so they can weed out some of the more difficult ones to work with, which is really quite key. And also then ones that are relatively efficient in terms of the questions they ask, because quite often bridging lenders will ask curveball questions right at the dying minutes. And then rate. I've got some rates on at the moment for bridging lenders that will complete within those timescales, 28 days, at 0.69 a month, which is industry leading, for a 75% loan to value bridge, which, as long as you've got a reasonable background income, could be serviced as well, so you would get that full 75%. Pretty good deal, I would suggest. It's not, it's more expensive.
To be honest, yeah, even last year we was looking at 1.25% per month.
There were some that were up in that level, and then some of the more reliable bridging lenders were perhaps coming in at 0.8 and 0.85. So this is, that's quite a good drop in rate. And I've done quite a lot with these guys, so I've got a great working relationship with them in terms of being able to pick up the phone to the underwriters and get round challenges, rather than quite often what underwriters will do is throw up challenges and you then have to work a way around it. But yeah, good.
I mean, on that point, someone doing a development finance, we often talk about people, if they are doing a massive conversion, there's huge risks. So they should certainly use a limited company from that perspective. But I understand that there's many people trying to use a buy-to-let mortgage on a property that is being developed. So they're obviously saying one thing to the lender and doing another potentially. What risks are associated with doing something like that for this deal and future deals?
Oh, wow. Okay, well, if we start with the basic principles, a buy-to-let mortgage, the clue, I guess, is in the title. It's a buy-to-let. And ever since we had the credit crunch, underwriting and criteria from the Prudential Regulation Authority and the FCA has changed. And the lender has to demonstrate that you have an income that is greater than the cost of the mortgage and that you have an ability to service that debt. So if you take on a project, then don't put a tenant in it, you have contravened the T's and C's of the mortgage product that you were given and the product that you signed a declaration to the lender that you would inform them if you didn't have a tenant for more than 30 days and if you were carrying out works to the property. So from that perspective, whilst people do it, and I guess some people get away with it, if it goes wrong and or the lender finds out, you have contravened your T's and C's of mortgage and you have technically committed mortgage fraud, which cannot be supported in any way, I would suggest.
I mean, being blacklisted is the potential. Do lenders talk to one another? Because I mean, if you do upset one bank, they'll blacklist you. You can never get a mortgage from them at all. Is there some sort of code between banks to say, well, this person's doing this, don't work?
There's a system that's not at all publicised. It's called Hunter, which they can share information on, or they can report to credit reference agencies as well. generally then not so much. But yeah, there are ways they can share information, and it does pop up.
Yeah. I guess if you're going to be doing this a couple of times, you're upsetting a few banks. Even if it doesn't get out, you are still limiting your kind of rates that you potentially could get from them in the future. So it's not a good idea.
It also makes my job as a broker difficult, because if I then know that that's what's happening, I'm party to that decision. Does that mean that, for obvious reasons, that's not something really that I can be party to?
Yeah, that is very good point. So I think, Simon, we'll close it off from there. But there's some valid points there for anyone that is obviously doing conversion projects or development projects. So thank you for your time on that one.